Thanks for joining us. I'm Marlin Bohling with you with a look at our ag commodity trade now that we're about 45 minutes into our trading session today. And we're going to take a look at the quotes. We'll start with the corn board and our quotes provided by Bar Chart. Well, things really fell off of the levels that we had in the overnight Globex trade, but they're starting to stabilize a little bit. So currently you have your July corn now 5.5 cents higher at 6.88 1/4. So after dropping significantly after the open, we have bounced off of that now by roughly about 4 cents or so. Currently, you have the December new crop corn now trading 16 1/4 higher at 6.07 3/4, and even that is still about 11 cents off of its overnight high. Let's switch over to soybeans, see what they're doing. We have July now trading a dime higher at 15.93 3/4. So it has bounced off of its earlier low this morning by about 9 cents now. And you have the November new crop soybeans hanging on to a gain of 23 1/4 cents at 14.58 3/4. So after they sold off the corn and soybeans quite a bit at the open, they're starting to get a little buoyancy to them right now. Now let's move on to the wheat. In Chicago, July wheat down 1.5 pennies at 6.86 1/4 after a high overnight of 7.04 per bushel. In that Kansas City market, let's check out the July contract. We are now trading 4 1/4 lower at 6.32 1/4 per bushel. September down 3.5 cents. And in the Minneapolis market today, we currently have July down 10.5 cents at 8.02 1/4 after it surged ahead overnight. It got as high as 8.43 1/2, and now all the way down to 8.02. Wow, that was quite a turnaround, about a 41 cent reversal there. And believe it or not, we had been almost 20 cents below where we are now at one point. So wild action in the spring wheat trade, and here to talk about all of it, we go to our in-studio guest. How you doing?
I'm doing great.
It's Chris Swift of Swift Trading in Nashville. Good to have you back with us.
Thank you. Good
today.
morning.
Wild action to get things started here today.
Yes.
Lots of volatility, plenty.
Absolutely, and I think it's a great sign to expect more.
Really?
Yes.
Okay, so we're just kind of whetting the appetite a little bit right now.
I believe so. You know, we noticed that the CME began raising the margins and began raising the price expanse of what they could trade within a day. And by golly, we've seemed to have met that price limit several times just within the last 4 or 5 weeks.
Okay, so let's review, shall we? What do we have now for limits? We now have 60, or excuse me, we have 40 on the corn,
40
right?
on the corn.
It used to be 25, now it's 40, and on the soybeans, now we're up to $1 regular limits.
It's either $1, 90 cents, or $1.
Yeah,
It's up there.
Yeah, I'm pretty sure it's $1 for regular limit, and then on the wheat in Chicago and Kansas City, it can go 45.
45, yep.
Minneapolis, I believe, can go 60 all by itself. It's a little bit unusual, but do you think there's a shot they may need it today on any of these?
Maybe not necessarily today, but I think going through the summer, there is some replanting going on from last week's frost, and now this week we had severe 100-degree temperatures in a lot of those areas. They got frost and some freeze damage to it, so the crop is not going to be quite as big, I don't think, as what USDA has started out with. There's plenty of time to replant in some areas, but we just don't have the weather conditions to replant. So you may have the time, but you just don't have the weather conditions too.
And here for months, all this talk was focused around we have to have a perfect crop.
Right.
It has to be a perfect crop.
Right, and it's not.
So what does that mean? As we get into the summer, I mean, volatility could be even increased.
Higher
right?
volatility and greater price expanse. You know, if they have to go into rationing corn, so we know that China has been the big buyer of corn consistently, and we don't have any idea when they're going to slow or stop that. So what we look for is that combination with any kind of weather factors that may reduce the size of this crop.
Oh, it's going to be hard to pull that trigger this year, isn't it?
It's going to be a lot of fun, no doubt.
On it. Wow. Okay. And don't forget, we'll have a new crop progress report coming out and condition report later on this afternoon. We'll be back talking more with Chris about our livestock trade in just a moment. And we're back with Chris Swift. Let's open up our livestock trade today here on a Monday and take another look at it. Of course, it's been trading for about 45 minutes. So here we go. On the live cattle board, we now have that June contract down 37 cents. We're at 116.45. And the active August contract, I believe, Chris, this is where most of the attention is focused these days. It is down 42 cents today at 117.65. October down 32. As we move on to the feeder cattle trade, this is where we had all kinds of downward pressure last Friday. We had more follow-through pressure this morning. August is now down $1.22, Chris, at 148.70, in September down 137. Check that, now down 140 at 151.35. So everything over $1 lower on the feeder cattle trade here to begin the day. That's about a $5 drop or $4.50 drop since last Friday morning or something like that.
It's been a $14 range. Wow.
Wow. Okay. What does that mean now with the higher grain prices, and they're starting to levitate a little higher again after selling off in the beginning? Is that going to weigh more now on the feeders the rest of the day?
We think it will. We have not really seen the futures market act kind of the way you would under these circumstances with higher input costs, lower revenues generated by the fat market, but seemingly the basis spread is here to stay for at least a little while longer until we get into that July time frame. That's when we see a large majority of cattle marketed through that July time frame. So we see how humans actually go in and actually participate and create the feeder cattle index, see what that price turns out to be, and then we see what the futures do after that.
What if it turns off hot and dry in the high plains?
Well,
Is
it's
that going to
already
help
there.
the feeders?
It's already hot and dry.
Right.
No, anything from this point that shoves more cattle into a liquidation type theory is just not going to help anything. You've already seen an increase in cow kill. We've already noted 2 quarters in a row of an increase of heifer placement. So from this point forward, any more inventory that you have to push off of the plains only goes into a very inefficient processing system right now.
So you're thinking hot and dry would mean more cattle moving to market?
That's
just to
exactly
get them off
right,
the
and then have
pasture.
to get rid of them and a little bit lower price.
And that would in turn lead to weakness.
Yep.
All right, let's take a look at, let's go to the lean hogs. Here we go. Lean hog market right now. We currently have the July contract down, or excuse me, I'm used to saying down on the cattle. We're higher, 285, Chris, at 123.45. And you have August 260 higher at 120.17. So they're completely ignoring the weakness in the cattle market.
Yeah, they are.
How are they doing that?
You know, I'm not real sure, but we know that the quarterly hogs and pigs report has showed several declines in a row. So we know that pork production is down. They had that PRRS disease a couple of weeks ago that impacted it, and there's just nothing been expansion-wise in the pork production yet to say that we've got more pork on hand than we had before.
Wow. Okay. Well, thanks for coming in, Chris.
Absolutely.
Good to
Always
hear
a
from you
pleasure.
again. Appreciate it. Chris Swift of Swift Trading. Tammy, back to you.